Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, April 25th, 2018. It's about 8:45, quarter till 9, a little before the markets open, about 45 minutes to go today. And I just did a market update last night, a market wrap video. Usually don't do anything so soon. We haven't had any developments since then. The futures are right about where they closed yesterday, give or take. So nothing new has changed. But I did miss something yesterday, and that's important. Yesterday, was bothering me, not because my call was wrong. I was expecting an upside, more upside follow up to the false breakdowns that we had on Monday. But that wasn't it. There was, we were down, and although in that video, now I did say, and this holds true, that the move was just part of the norm lately in the last few months. To see the S&P down, what was it, 1.3 or something percent, one and a quarter. The SPY was down, more. I'm sorry, the QQQ or Nasdaq 100 was down more, and that's to be expected. That's the tech-heavy Nasdaq 100. Google or Alphabet had reported last night. But uh, I had to run out right after the close, right after I wrapped that video yesterday, and I didn't get back home till late, after dinner time. But something was eating at me, so I sat down and I went through the charts for quite a bit, for hours last night. And if you followed me for a while, you've probably heard me say this dozens, if not hundreds of times over the years, depending how long you followed me. I always try to keep track of, the all the different time frames, even if I'm living in the world of the intraday charts, which I have been lately. The vast majority of my trades, I've done very well trading the, E-mini futures lately and QQQ derivatives, index ETFs because of this volatility with those moves like yesterday. Normally, I've been on the right side much more than the wrong side of those trades recently. Got stopped out pretty early yesterday on my long positions and wasn't able to, never, just held back, didn't short. Something didn't seem right. And here's where I'm going with this. I have fallen, recently, subject to what sometimes happens, get lost in those intraday charts. If you followed recent videos, I've usually led with the 15 and 30 and 60-minute charts and briefly touched on the daily and weekly charts, which we hadn't had a lot of significant developments. And where I'm going with this video, I think this is an important one. There were some technical developments that were very significant on the longer term time frames, which I missed yesterday, and which, now in hindsight, uh, may have contributed to that move and may have longer lasting implications. So just to summarize this, what I had said yesterday in the video, we do need to snap back and regain those levels. I don't really plan to get to the 60-minute charts. Look at that video if you haven't had a chance. But those recent necklines on those 60-minute and 30-minute inverse head and shoulders patterns, that level where, we broke it very briefly and shallow, by a small margin on Monday, and then yesterday market went up. We went down below again, took out Monday's lows, and that's when the waterfall sell-offs, that's when the stops were hit. Now, again, that was me living in the world of the 60-minute charts. But what I'm going to do here, and again, I think this is important, is revisit these weekly charts. And more importantly, I've been trading the NQ as my preferred trading proxy when I'm focused on the intraday charts and actively trading, the broad markets as a whole. I do that because there's more juice, there's more bang for your buck. It's like trading GDX versus GLD. The gold miners move a lot more than gold moves. When gold goes up 1%, the miners will go up 2 or 3%. And I'm talking trends mainly. And the same thing with the NASDAQ because it's concentrated. It's concentrated into mostly tech stocks. I jokingly refer to the NASDAQ 100 or QQQ as a tech ETF with an Amazon kicker. Now, with that being said, we do have earnings this week coming out on Amazon, Intel, Microsoft. Those are Thursday after the close. So, just be aware of that because those are most likely going to move the market on Friday and into Monday. Probably any volatility we see on Friday will probably carry through to Monday. So just keep that in mind with your position sizes. All right, let's get into the charts. I'll tell you what I'm talking about here, and we'll wrap this up. Now, all I'm going to do is go over the SPY QQQ briefly. Those are the two main large cap indexes I follow. They're much more diversified than the Dow Jones, which only has 30 stocks. And And then what I like to do, and I've done this again, if you followed me for years, you know that I often will do videos or post some static charts on the 11 sectors within the S&P 500, because the stock market, and when I refer, or most people refer to the broad market, they're referring to all the stocks out there. Now the S&P 500 is only large cap stocks, your largest companies, but those are by far, they make up the bulk of the market cap in the entire stock market. They vastly overshadow the small caps and everything else. So you want to know where the U.S. economy is going, watch the large caps. You want to know where the stock market's going, watch the large caps. And within there, you have 11 sectors, and I'm going to go over those sectors in here. And I think that's important. Most of you might not want to hear, look at 3 different time frames on 11 different charts, but I do believe this analysis is pretty important and significant. All right, this is a long-term chart. We're going to start out with the weekly charts. This is a weekly chart, goes back 10 years. There's the lows from the end of the bear market back in March 2009. So this is the beginning of this bull market, second longest in history. And as I've maintained for quite a while, we are most likely in either the eighth or the ninth inning, possibly, very possibly in the first inning of a new bear market. But if not, we're in the eighth or ninth inning of a bull market. So there may be more upside this year. And you can see I have 2 different trend lines. I have this white trend line off the 2009 lows, captures some of these reactions here. That's fine if you have these intra-week spikes below those candlestick tails. Comes in, catches that. Actually should tighten it up right about there. Catches a couple more candles, and that one we're above. So there's long-term trend indicators, as I mentioned, have not rolled over. Some of my intermediate term trend indicators, one of my favorite, the 20 and 50-day moving average. I'm sorry, the 50 and 200-day moving average. That's bearish right now with the 50-day under the 200-day, and I use the exponential moving average on that one. And then I have this other trend line here that comes off the lows in early 2016. I guess I missed it there. That one has broken, and you can see, and I talked about this a lot in recent weeks. You just might have to revisit those videos because I don't want to go too much into things that I've covered. This I've covered quite a bit. So the SPY broke down, and we back tested right here. And we've since moved lower with a pretty red impulsive candle. Now we're only halfway through this week, and as I said, a lot can still happen. So the markets, to really undo some of the bearish technicals that have happened recently, they need to reverse. They need to get back up above those levels I mentioned, or else the bearish case will only strengthen from this point. And again, this is what I would call the final last ditch trend line. It needs to hold this trend line. It needs to hold those lows as well. There are obviously important levels. I'm talking about these 2 reaction lows from the late January to early February lows. We had the sell-off, and then the one that just wrapped up here in early April. Those lows are important as well. So you have a confluence of very critical support. This is, again, the longer you go out in time, these weekly charts, they have much more significance in a 15-minute chart, 60-minute chart, and that's what I lost sight of, looking for the rally this week, and I'll get to that in a second. Let's zoom down here. This is a 2-day chart of the SPY. Same story. You can see the trend line off the early 2016 lows. That was that smaller or secondary trend line I had. Breakdown, back test. This was a stick save. We broke down, but we regained it, and then we had an impulsive breakdown. So this is bearish. Again, looking at that other trend line, there's still a last ditch, primary uptrend line, but you also can see down here the PPO is in bearish territory. Usually the 0 line when it's trading above or below that. That's bullish or bearish. You can see back here we had a cross, and I like to use that signal line, bearish trend. That was a big correction, bigger than the one we had now. There was another correction, but for this is 4 years. You can see that almost, other than these 2 brief periods here, the 9 EMA, the signal line of that PPO, was trading above there. So this trend is clearly bearish. The 50, 200 day and some other trends I have, those are intermediate term trends, by the way, guys. those are still bearish. So you have a bearish trend, you have a breakdown of a trend line and a back test, and that was and I did actually on the 60-minute charts. We were long on that ride up, and I mentioned getting out a day early and then shorting and catching a good part of that short down, but then looking for a bounce, and that was a mistake in hindsight, and may still prove to be a mistake. Well, I'm not in those shorts now, but or those, I'm sorry, the longs that I reversed to for a bounce this week. But let's see what happens here. All right, there's a daily chart. The only thing I wanted to point out here is, and this is important as well, and I mentioned this yesterday. See the PPO right now curling over. You can see the blue line. The PPO line has sharply rolled down right at the zero line. That's pretty bearish. And if we get more downside, that will confirm that. So we've broken down below the zero line. The PPO is in bearish territory. If that blue line crosses the white line, the signal line, you have a bearish PPO cross, which is a pretty good sell signal. Usually when you get the bearish crossovers, that gives you a sell signal, and when you're trading above this zero line. So again, there's two sides of this to undo this potential bearish setup right now, or these bearish technicals, I should say. The market needs to rally, and it can do so. It may want to go for another back test to this line, another rally. It may want to put in that right shoulder. That pattern may be foiled on the head and shoulders I talked about on QQQ. We'll get to that. So I think we're at an important point, and I'm not going to be here throughout most of the trading day today. I'll be back in later to answer questions, but I wanted to point out what we're looking for here. So this market is really at a pretty important point. It needs to rally. It needs to rally soon, or this bearish case is going to firm up here. It can be, we can undo some of these bearish technicals by moving higher, moving these indicators back up, getting prices back up above certain levels, but we don't have it yet. All right, now we'll go to QQQ, and then we'll wrap up just looking at the sectors, because I think that's important, again, because the stock market, the broad market, is simply a sum of its parts. And those parts are the 11 sectors that make up the S&P 500, which is much more diversified than the Nasdaq 100. Nasdaq 100 might be a great trading vehicle, it was a great long, buy and hold vehicle for the bull market from off the 2009 lows. Actually, the NDX bottomed in 2008, November, before the rest of the market. And tech has by far outperformed. So again, it's an important index. A lot of people are in it. Now let's look at this weekly chart. Here's a trend line off the 2015 lows, very well defined. I've covered this quite a bit lately. You can see that we've had a few stick saves, meaning intra-week. We pierced that trend line. We pierced it here intra-week. But somebody asked recently about trend line drawing, and I say I use a trend line. They are subjective, but I try to capture the most bodies and tails or wicks on an uptrend line. So there you have a wick, there you have a wick, there you have a body. You let the wick slice through, that's fine. Those are intra-week moves. All that matters on a weekly chart is how you close the week. So the fact that we closed right back on that trend line is significant. There it is. We broke it, recovered. And then now here's where we're at today. This one closed right about on it. But as of today, and again, this is where, why I said we're at a critical juncture in the market. We're below trend right now. Not by a whole lot. And we still have 3 days to go in the week, 3 trading days. But if we move lower, we build on yesterday's losses. If the market doesn't like what Intel, Microsoft, and Amazon have to say Thursday night, and they sell off on Friday, we go down. We're going to revisit those lows, and there's a good chance we'll take them out. Okay, had to pause the video there for a little while. Had a phone call with my contractors here, so I have to get running soon. We've got some projects going on outside the house today. So that's that. So let's watch what happens with Qs this week, or the QQQ, I should say. Daily chart, I think I covered that. The PPO, or at least on the SPY I did, the PPO, you can see getting rejected on a zero line back test. And again, just simply go back. And we still have the signal line well below as well. I usually wait for the signal line to cross, but right now we're getting a rejection on the PPO line. And again, you go back, this goes back a few years, and you can see other than this one little whipsaw signal, that PPO has remained above, especially that signal line, the 90 MA, and it is below. So we have that going on. And if you missed it last night, there's that level 16, we'll call it 161.70 on QQQ. It was as resistance back here, worked as that neckline. And it, and that inverse head and shoulders did play out. It didn't play out to the full extent of the move, but it was resistance, resistance, resistance. Resistance once broken becomes support, which it was here. Acted as support again. That was what I thought might have been the little stop rate. But then when we went back down the next day, and we had no business doing that, and went below there, that's where the waterfall sell-off started. But again, the point of this video, I already covered that, is what I'll get to here in a second. And that is what the stock market as a whole looks like. Let's roll into the sectors here. Let's start out on weekly charts. I'll go through these in no particular order, but they are all the 11 sectors that make up the S&P 500. So these sectors are the stock market. This is a 10-year weekly chart. And guys, I'm going to run through this fast because I got to get going. If I don't make mention, just look up here at the time frame. I'm going to jump around between three time frames: a weekly, a 2-day period chart, which is just simply every candle is 2 days. It's a limitation. I love this charting program, but I hate the fact I can only go back 2 years on a daily chart. So to see a 4-year period, which I need to capture a lot of these trend lines, I have to go to this 2-day period chart like this. You go down to a daily chart, it's only going to give me 2 years. So there it is. This is XLU. To me, a very well-defined, clean trend line. And that, big trend. This is the entire bull market run off the 2009 lows. And that has terminated so far in with divergence. This is a divergent high. And that's a pretty ominous sign. I trade these divergences quite a bit, and you can see we broke down, and since we've broken down on the utilities, we've been flagging below. You can see prices back testing that trend line, but failing to recover it. So this is a very significant development, and again, the weekly time frame takes precedence over the daily time frame, which takes precedence over the 60-minute charts. So as of now, I can give you a few pluses. We do have looks like a recent bullish crossover on the PPO, but we're still down below that zero line. So you have to be skeptical. What happens if we're in a new bear market? If these were the highs, what's going to start to happen is the same thing in reverse that we've had for the last 9 years. And what that is during a bull market, sell signals, bearish setups, technical patterns, they tend to either not play out at all, or when you get a sell signal and they break down, and just when it looks like things are starting to get going on the downside, the market reverses and they gunned it to the upside. That is the nature. I traded the last bear market. I've traded bull and bear markets. That is the nature of a bear market. So if we are in the new stages of a bear market, and that may be very well why those technical, I was looking for a bounce last week based on the 30 and 60-minute charts, but I missed the bigger picture that a lot of these sectors and the market, they were back testing key levels. So I'll need to go to a 2-day. So here it is on a 2-day period chart, just that same trend line zoomed in a little bit, a little variation actually there. That other trend line goes like that. So there's a 2-day period chart, and you can see here the PPO is coming in to back test that zero line from below. Daily chart on utilities. It's been one of the better sectors lately because utilities are defensive issue companies. During a recession or an economic slowdown, you don't stop paying your water bill, your heating bill, electric bill, and all that good stuff. And that's why they tend to hold up relatively well compared to other companies during economic downturn. XLRE, this is the real estate ETF. And by the way, you'll notice that I use out of the 11 sectors in the S&P 500, in my watch list, which is down below, I have all what I call the X's. These are all ETFs that begin with the letter X, and those are the Select Spiders sector ETFs. So you have one for each sector, like XLE, for example, is energy. XLF, the F is financials. We'll get into all those in a second. So there it is on a daily chart. And, we're going to have to actually go out. The one limitation on XLRE, Spiders was late to the game with a real estate ETF. They actually spun out the REITs from within the S&P 500 a couple years back, and I think that's why they were late coming out with a real estate ETF. So I use IYR as a proxy there. I've traded IYR for many years. It's been around a lot longer, and you can see here, I don't have a very strong opinion, but there's a trend line that's broken down. We also have some horizontal support there around 71.83 with a reaction. So this chart doesn't scream bearish. In fact, I like the REITs more than a lot of other sectors now. Don't have a very strong read on this chart, so I'm not going to spend too much time. And again, it's not a very important part of the S&P 500. You can see down here, I don't know if you can make this out in the video, it's only a 2.7% weighting, so let's not really focus too much on what the REITs do because it's not going to have a big impact on the market. Just like telecom, only about a 2% weighting in the S&P 500. Bigger picture telecom, and I've covered this quite a bit, has just been locked in a about a 15 plus month sideways trading range indicated by that yellow box. You can see it here with the white box. You can see the uptrend line that was broken, but we've traded sideways in telecom. Now, I will say, that every time we get up to this top of the range, like this most recent high was a divergent high, so it's not looking great. But either way, we're in a range. Let's not try to read too much into that right now. And again, telecom being only 2%, I probably should have covered those lower weighted sectors last. I didn't have these in any particular order. Here's XLP, consumer staples. It is at support. This was a recent trade idea. It first hit the first price target, and then it pulled back and hit the suggested stop. So it was a winner if you took profits at T1, and it was a loser if you were holding out to T2. But it's at support now. Potential divergence, but potential only. The indicators would have to turn back up here to put in positive divergence. It's a simple wash, rinse, repeat. We had negative divergence here, correction. Positive divergence here, rally. Negative divergence at the high, correction. So you can see all the divergences. So we have potential positive divergence, but these indicators could keep heading down. If support is broken, they will continue to head down. And this is what it looks like on a weekly chart. There's a trend line. Trend line was broken. We had one little false breakdown there. We kicked back. We put in a powerful divergent high. And again, on a weekly chart, um, it's not a good thing to see these big divergences. So we are at support. And if this support around $50 goes, I see about another 6% or so, 5.5, 6% downside to about the $47 area. Staples should hold up relatively well compared to the rest of the stock market because, as the name implies, these are consumer staples. Although, when you look at the components they have, I think it's chock full of Walmart. Walmart, although they sell a lot of staples, they also sell discretionary items like big screen TVs and all that. So it's not a perfect representation of consumer staples. Things like Procter and Gamble, shaving cream, razors, things that you have to buy. All right, let's move on to the next one. XLF financials. Financials are at a very key level here on this weekly chart. In fact, we can draw this line. That's how I had it drawn. This weekly line wasn't really clear there. There it is. So what I'm doing is I'm capturing that low, capturing the body on that candle, capturing these lows, and we have broken down below trend, an important trend line, following a divergent high. That tells me a lot too. If you break down during trend, early on in a trend, and the overall trend indicators, everything else is bullish, great. But right now we broke down, we back tested, and we're right above a pretty important support level, around 27, give or take. We've pierced it a few times on this weekly chart, but again, if we go down much further, the bearish case will really begin to firm up. So if this market can rally higher, maybe we go on and back test for several weeks. Maybe we come back higher. Maybe we even regain this trend line. And if we do, there's certainly some levels we could target on the upside. So again, the point of this video is just that we're at a pretty important technical juncture. Here it shows you better on this 2-minute chart. I'm sorry, 2-day chart. Look at all the reactions on this trend line. Very clean. There's the divergent high, extreme overbought readings, and I've covered XLF recently. We've broken down and we've been back testing below the trend line in this flaggish type action. So this thing looks like it's going to resolve one way or the other soon. There's a gap right there above it. So we're either going to regain that trend line or continue to test for a while. You're not going to back test forever, or we come down out of there and we'll probably see a sharp move. So let's keep an eye on XLF. From a daily chart, you can see it again really close. If you zoom in there, there's that gap I talked about, some resistance above, and I can add one more support line for you XLF traders. All right, next one up, go back to a weekly chart. Healthcare, XLV. I haven't drawn a trend line here, but I can do that for you right now. These trend lines are pretty clear. There, you go back again to the 2009 lows, a lot of reactions. I need to tighten that up, try to capture as many of these bodies and or candlestick wicks as I can. And there it is. So XLV has just broken down recently in the last few weeks when you zoom in here and has been backtesting but below trend. This trend indicator at least is still bullish for now. Looks like it wants to curl up. So, we can undo these bearish developments by getting back above trend, but we're going to have to do so soon. Otherwise, it just increases the bearish outlook. Let's look at that on a 2-day chart. There it is, 2-day period chart. PPO is still in bearish territory. Made a recent bullish cross, but now it's flattening out, and that may be a whipsaw signal. It looks like it's turning back down, so just one to watch. And XLV is about a 14% weighting, so a pretty significant component of the S&P 500. All right, next up, only a few more to go. XLE. This one, as you guys know, I am bearish on crude, ready to pull the trigger on an official trade on the site. We ran into this resistance the other day, 73.81-ish, and hit it like a wall, stopped there, and we've traded there in the last few days. Put a bearish engulfing candle in yesterday. PPO is starting to roll over. Again, I'm going to cover this in detail with some price targets for members of the site because I mentioned adding quite likely oil or some of the crude ETNs and maybe some of the energy sector ETFs as shorts. This is XLE on a 2-day period chart. I'm going backwards this time around, and here's the weekly. So the weekly, I don't have a very strong read on this one. It's really just energy has grinded around. We've been in this range right here for a while, and we're sort of in no man's land from this perspective. What I mean by no man's land, that's what I refer to when you're between support and resistance. So if we were up here at 79.19 and we had either a consolidation first, and I can make the case for a breakout to go long. That would be a long setup. Or if we had a divergent high and it looked like we were going to get a pullback, you could short at that level. My suspicions are we're going to pull back before we get there. And it may just be this. It may be a pullback and then a thrust back up to that top of that range. Anything's possible. But right now, I still favor some weakness, some downside in the energy stocks. So there's outlook for XLE. And again, not super strong convictions, but some of these other ones I do have pretty strong reads on the chart. This is XLY, Consumer Discretionary ETF, weekly chart. Some of the things on a lot of these ETFs, as well as the market, that stand out were these overbought readings. On the S&P 500, we had the most overbought reading in history on the weekly time frame, at least going back, I went back 20 or 30 years. We'd never been so overbought in the market. Um, and you can see that with XLY. So there's a trend line. We're still above trend, but keep in mind, we look at the proximity of the trend line, and I need to tighten that one up. You can see it wasn't right on the line. Sometimes you have to make some fine tune these lines when you zoom in. There it is. So to try to quantify it for you, from where we closed yesterday, we are only about 1.9%. That's just one bad day away from that trend line. So, this market can rally, can kind of put some distance between these important levels. It may come on, you go on to rally up here. There's some resistance there, target. There's the new highs. So, like I said, at this point, I can't rule out new highs in the market this year. But I can also say that we are at a precarious technical position because just a couple bad days will have taken these sectors that are not already below these primary trend lines. It will have taken them below the trend lines. And then once you have, let's say, 7 or 8 of the 11 sectors of the S&P 500 broken under trend, key trend lines with their trend indicators rolling over bearish, that tells you that we're probably in the early stages of a larger correction. XLY, this is consumer discretionary. And, I didn't note it on all the charts, but we had this in the stock market, in the S&P 500 and the NASDAQ 100 and just about everything else, is what appears to be a blow off top, that strong one-sided, almost vertical advance from December, especially from early January into the highs, that was very indicative of a blow off top. Not only the upward price action, the extreme bullishness, but also the subsequent sell-off. The blow-off tops tend to end that way. Parabolic moves and/or blow-off tops. This one wasn't exactly parabolic, close to it, but you had that big, sharp follow-up selling, and we've yet to take out those highs. So the only thing, Nasdaq 100 went on and made new highs, but after that, but just about everything else hasn't. And so there it is. XLY is still above trend. The trend indicator is in a precarious position right now. It looks like it wants to make a bullish cross, but so far it started to, but its lines have flattened out. This has all the makings of being rejected as a bullish crossover, but I can't say it has been yet. These lines are flat. They're too close. I'm talking about the signal line, the white dashed line, and the blue line. So these are all levels to watch. I would replicate these charts. And the more sectors you have giving way, remember we have trend lines, and then right below that we have those two reaction lows from this sell-off so far in 2018. Those two big legs down. Next one up. Well, let's see if there's anything on the. No, I don't have much on the daily chart other than same story here. On most of these sectors, we have the PPO below trend, below the zero line, rolling down at that zero line. That doesn't look so good. So there's still support, and like I always say, support is support until unless broken. So let's see what the market can do this day. I think it's going to, or this week, and we're probably going to have to wait until early next week with a lot of those three big FANG or FAME companies, FAAMGI. I call them: Facebook, Amazon, Alphabet, Microsoft. Google, no, I missed one there, but I always do that because the G messes me up. A was Alphabet, Amazon, Apple, and Alphabet. Yeah, those are the three A's. They are reporting, three of those are reporting on Thursday, including Intel, which is the sixth largest company. That's why I'll sometimes refer to those as FANGI, FAAMGI. And you're going to have Microsoft, Intel, and Amazon report. So let's see what happens. And then here you can see there's some pretty big gap support. XLK, you overlay a chart of XLK, it's going to look just like QQQ, very similar because of the tech heavy weighting. So what stands out to me on the tech stocks is that they're below trend. I have here several lines, but we have some pretty significant support down here. And these trend indicators, at least the PPO is not looking so hot. The RSI is heading down. So this one doesn't look hot right now. There it is on a weekly trend line, and you can see tech is below trend solidly so far this week. And it would take a heck of a rally to get back above. In fact, we broke down here. Oh no, this week. That's a red candle. That means we closed down below trend back on the week ending March 23rd. Back tested. You can see how perfect. Look at the doji. There's the body. That means we closed right on that trend line. We didn't regain it. We tried again. We went down next week, tried to regain it, failed. Tried again. We closed right on it. The green candle means that's where we closed, right on trend. Here we tried to regain it intra-week but failed. The red candle means we closed just below it, and now we're below. This is bearish action. These are the charts working. These are technicals. These aren't randomly placed lines. And right now, tech being, by the way, the largest component, this is a 24, about a 20, almost a 25%, one quarter of the S&P 500, and well over half of the Nasdaq 100 is made up of tech. So this chart carries a much higher weighting than those other ones like the REITs and everything else that I covered there. XLB, only a 3% weighting, so I won't spend too much time on it, but let's just look at the weekly chart. You can see below this trend line breakdown back test and rolling over, very overbought. We could turn up here. This trend indicator is still above the zero line. XLI, industrials. This is a pretty important component of the U.S. economy, the industrials, obviously. And there's those recent lows. You can see we've broken down below trend, back tested, and failed there. 2-day period chart. Again, this is what I missed yesterday. This is what I should have been looking at heading into the weekend, heading into this week, I should say. And I was focusing on those 30 and 60-minute charts, but not looking at how many of these sectors were back testing these trend lines, which were recently broken. This is a 2-day period, 4-year chart. So here's early 2016 lows. You can see a very well-defined trend line in the industrials, breakdown, back test. So technical analysis 101 says you do one of two things if you're short selling. You either short a break of support, which you would have done right here, and then you would have grabbed that red candle. You would have covered down here at that previous reaction low. That was natural support. Um, or you wait to short on a back test of resistance from below. A trend line, which is support, becomes resistance once broken. Any support level once broken becomes resistance. So we back tested, hit that level. You can see almost to the penny. We hit it again the following week. That's two failed back tests, two attempts to regain that trend line, but failed. And then boom, a big red candle over the last couple of days. This is a 2-day period chart. And again, that's what I missed by taking my eye off the bigger picture when I should have been looking at where all these sectors were. You can also put a downtrend line now. This downtrend line may continue. This may be a new downtrend that started, but we have to take out these lows. So again, we're at an important part of inflection point in the market. If we can get back up there, take out those trends, maybe we continue to backtest this trend line. Maybe somehow we regain it, and that would be a very powerful thing. Otherwise, we could be now in a new downtrend in the industrials. Okay, this has been Randy Finney with Right Side of the Chart. I have to wrap it up here. Long video, but there was a lot to cover. And again, I'll be back in the trading room and on the site later this day, hopefully before the market closes today. Have a great day, everyone.